Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark explains why equity markets are still booming. Oil and Gas Investment Bulletin's Keith Schaefer on rising gasoline prices. And Morgan Report senior analyst David Smith chats about gold's sudden charge. We talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Ross Clark from CIBC Wood Gundy. We're going to be doing a little chart work today, so you can actually follow along at home on your computer as we chat on the TalkDigitalNetwork.com. Ross, welcome to the show.
It's a pleasure to be back.
You were just checking your computer and trying to find out if anything was down this week in the markets. It looks like the equity market was doing well. The Canadian and U.S. dollars, how did they do?
Well, from the currency perspective, the Canadian dollar had a fabulous week, closed up at 93 cents against the U.S., and that's the best that we've seen in months. Interestingly, for all that most of the analysts had been looking for some pretty weak numbers, and the Bank of Canada has been trying to talk the Canadian dollar down. The consumer price index figures that we saw this morning and the comments, I guess, from the U.S. Fed and Yellen earlier this week have been pretty supportive to Canada. So it's had a pretty good run, as I say, 93 cents. And in terms of the charts that we do, looking at this still as a bear market, a downtrend. When we look at the bigger picture rather than just the last week or two. And we've popped a chart up there for the Canadian showing it and how it the rally into the highs a few years ago and the rolling top, and how that compares to, say, the some of these other tops like the NASDAQ in 2000 or the gold market back in 1980. And this one looks as though, given another week or two, it might get overbought enough that we could be setting up for the next leg to the downside.
On consumer spending being up this week, I understand all these deals that they have on television. You get employee pricing or some kind of special deal. That probably really helped. A question I had that was brought up by our correspondent in Las Vegas, Frank Underhill. He said the Canadian junior market and the Canadian exchange totally overpriced and overregulated, and he is getting or seeing a lot of business from Canada now moving into the U.S. junior markets.
Well, I wouldn't be surprised about that. Anything when you start to have regulatory issues, people will go looking for the easiest place in which there is to do business. It's interesting that the junior market sector here has really been driven down fairly dramatically to the point where, if anything, I would say that it's become excessive here on the downside. And anytime you get any kind of good news, and we take a look at, say, just even in the metals market here right now, take a look at the GDXJ, or the ZJG. These are the junior mining indices on Toronto, on the TSX, and on New York. And as soon as we've had a good piece of news here with the commodities starting to come back a bit, they are outperforming the senior indices by a good 20 or 30% off this bottom here. So it's when everybody's just become disdainfully bearish on something, that's when you get your surprise rallies.
Have you seen this happen before?
Well, it's most common actually coming off some of the significant bottoms when we look around. If you take a look at things like the equity managers who specialize in the juniors, and how devastated some of them were into last summer, when the metals were bottoming out and commodities as a whole were down. They did famously in the initial, now I say in the initial stages coming off the low, because what you really want to look for longevity is to be with the issues that are the strong horses in the sector, the ones that have the good underlying fundamentals, because there you'll get the move off a bottom, similar to what you would get with the junior names, but on the subsequent pullbacks, they give back less, and they tend to then, on the next bout of strength, likewise come on and make higher highs or equal highs again. And, when I look at what we've seen in the, say, from Christmas, where we had the bottom in the silver and the gold markets, had the first rally into March, a nice pullback into just the end of May. The number of stocks that held up in the sector there, that held up well, that gave back just marginally, maybe gave back 20-25% of their rallies. Those are the ones that have gone on in this last 3 or 4 weeks as things have come back to life. They've been the ones that have been capable of getting back to, in some cases, the all-time highs, or at least taking out the highs of this year. So it's my preference is more so to look at strong, as I say, strong horses within a sector. You like to pick those up on the pullbacks rather than looking out for the real cheap ones.
The old traditional blue chips still worth buying or purchasing?
Yeah, I mean, there's the various stages. The first stage off the bottom, your best percentage moves are going to be off the items that have been hit the worst, the companies that people might feel are on the verge of going into bankruptcy. And if there's any life coming out of the sector, they get the first push. But then as you get into the meat of a move, bull market, it will tend to be the blue chippers, which will have that sustainability. And then you've got to be careful at the tail end when those juniors come back into favor. And even looking at, say, within the metals themselves, you compare the bull markets that we had in gold and silver, the early 70s, mid 70s, mid 80s, and then again from 2000. The first 20 to 22 months of those, gold outperformed silver very significantly. As a matter of fact, in the mid 1970s move, silver was actually going down for the first 22 months of the bull market in gold. But it was in the final stages, in that last 10 or 15% of the time, where the silver market, which is the poor man's gold, or the one that tends to gain the interest at the tail end of the move, it's when that silver gold ratio really explodes that you're getting into your final phase. And with that, you tend to also see the juniors come to life, because as a market gets well into its move, people forget about the bear market that had previously existed, and with enough time, then they all just seem to want to get on the bandwagon.
Should you be looking to see if a company's CEO or top executives are selling off their shares? Is that a good sign that maybe they know something you don't, so you should sell too?
Well, you've got to remember that they'll all have reasons for selling. I would look at it that if the percentage of the holdings that a CEO or senior executive has that they're selling off is significant, that's important. But just if there is a dramatic move in the stock price, it would only be natural to see them looking to scale back their positions to some degree. I mean, it's just smart investment practice in terms of having an overweight position in anything to do some scaling back. But if the numbers do not fit in with what you would expect, then yes, I would take that as a red flag.
If they're selling off their shares too, what about their own people? I mean, if you work at a place and you find out that the CEO has just dumped half of his shares, how confident are you that your job's going to be there next week?
Well, I mean, that's if it's a small company, that would be a consideration. But I don't know that that's something that I would. It's not something that I would be tracking. Thinking that the the company is on the verge of some significant problems. As I say, there are hundreds of reasons why people will buy, and equally hundreds of reasons of why they will sell. I mean, it could be personal demands. It could be health issues. I mean, there are so many things, and to try and read into the significance of something, I think you want to be just looking at, say, percentage of the stock that they're selling, and see how the price is performing. If price is still continuing to move up and general volumes are good, follow the big money.
After the break, we're going to be doing some chart work. So get ready. Get to your home computer or your mobile device. Call up talkdigitalnetwork.com so you can follow along. And of course, we'll explain things if you can't catch us on the computer. We'll have more with Ross Clark next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Ross Clark from CIBC Wood Gundy. We promised you some chart work. You can follow the charts at TalkDigitalNetwork.com. So, chart number 1, what are we looking at?
Well, the first charts we put in there were the ones we talked about on the Canadian dollar and looking at various bear markets. And I think if people look at this, they'll see that the type of bottom that we've just put in here a month and a half ago is realistic in terms of providing us with some upside action. But we're at 93 on the Canadian dollar. We've got some trend lines up at the 94 to 95 cent level, and I think you'd be looking for relative strength, maybe up close to 70 as an area to be a seller in there on the weekly charts. That could be a pretty good trade for the third and fourth quarters of this year. The next item that we've got, we've been looking at the precious metals as the post-mania bottom. We are 2.5 to 3 years from the top, and that's the typical position where a market will try and put in a significant bottom. And when we take a look at things like the NASDAQ top, the Nikkei top, the Dow of 1929, all of those markets dropped 60, 70, 80% in their first 2.5 to 3 years. And if we look at the mining indices, that's what we saw. The Huey, the GDX dropped down by close to 70%. So they are right in, I wouldn't say the norm, but if we take a look at what they did and what that implies, the implication was that we are in the position of building a base. We had our first really good rally off the bottom December through March, corrected down and found support here at the end of May, and it's appropriately positioned to what we saw in those other three markets that I'm using as an example. The nice thing that's happened coming off the turn here is that going into that last week of May, the miners started to outperform the bullion. This is the same thing we saw in the middle of December that was the precursor to the real strength in the first quarter of the year. And from my work, as we have been walking down from that March high, I had a series of resistance levels that were significant in both the mining indices and in the gold price. And as of this week, going through 1293 on gold, 1300 intraday, that's enough for me to say that we are in the next stage of the basing, where we have a fairly definitive conclusion that the low for the year should be in place, and we'd be just looking for maybe 50 to 60% corrections of this last month's rally as the key support level. This, I think we have the potential in gold to maybe get up into the 1430 to 1470 range before the end of the year. And on the miners, the GDX, which is around 26 right now, looks as though it could move as an indice up into the range of $32 to $34. So could be a pretty reasonable move on the upside there.
Do we have any other chart to take a look at?
Well, we've looking at the equity markets. We've talked about the midterm election cycle in terms of where we sit, and the fact that this equity market rally is now 5 years old. Markets like to peak either late April into early May, or put another high in when you get out into July. We had a minor correction in the Russell 2000, the small caps. We also had one in the NASDAQ earlier this year. Pretty much nothing in the way of corrections to speak of in the Dow and the S&P. So it looks as though, from a rotation perspective, that maybe July could be producing a high here. The normal corrections within bull markets in midterm election years in the U.S. Would be in the 11 to 15% range. So not dramatic, but enough that would cause people some initial concerns. And do remind people that the fifth year of the decade has just an outstanding record since 1870. It's always been a year that's had an upside bias to it. So if we can have a decent correction sometime into the September-October window, I think people should be looking to load up their positions at that point and have full commitments, while at the present time probably looking back to pare back on positions.
What about U.S. Fed boss Janet Yellen telling us that they're going to have some form of quantitative easing continue for we don't know how long?
Well, I mean, with this, it's so supportive in general to the marketplace. And, you take a look around the world, where do you put your money these days? The bond market isn't providing the returns that people are looking for. So, the assets have to go somewhere, and there's still a lot of money that's still been sitting on the sidelines. And as time rolls along, this money needs to find a home, because it's not going to make the required returns for individuals or corporates if they're only making 1 to 3% on their money. You need more than that in the long term. So the equity markets seem to be still the only game in down, and corrections, you have to be looking and hoping for deep enough ones to make it worthwhile. My preference is to look at the sectors, find sectors that are correcting, and look to be on board those. We had nice corrections in the NASDAQ and in the Russell, and maybe we'll get one later in the summer here that provides a broader base correction.
And I have to ask about the Google stock split, 5-for-1. Is that a good move? Are they finally going to let other people in on the good times, or do they think it's going to be tougher to make money?
Well, I mean, you got a Google split 5-to-1. You have an Apple 7-to-1. Stock splits tend to, over the years, have been supportive in the near term, but they really don't have in my mind, a long-term implication to the stock, because all it's doing is for those who wanted to buy a Google or an Apple, you can still buy a smaller number of shares. You don't have to buy a board lot. The money that it will attract will be the smaller investors rather than the larger investors who are already committed and willing to buy those stocks. So it provides something for the man on the street.
Ross, is there a website people can go to find out more about your charts and what you think is going to happen?
Well, we've got the charts posted up on your site, and if they'd like to give me a call directly, my number here is 604-661-7759.
Coming up, Keith Schaefer on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Keith Schaefer, editor and owner of Oil and Gas Investments Bulletin, and you can find their website at oilandgas-investments.com. Welcome to the show, Keith.
Thanks for having me, Jim.
What a big day and a big week for energy news. The federal government says, yeah, go ahead with the Northern Gateway program to bring bitumen from the Edmonton area into Kitimat. But of course, this is nowhere near a done deal, is it?
No. I think the market really took this news, Jim, as a big nothing. Because what's happened now is that Enbridge really has to get their social license. The political license that they got here this week, the market knew that was going to happen. And for the simple reason that Prime Minister Harper can't go down to Washington cap in hand to President Obama saying, please, sir, pass our pipeline if he doesn't pass his own pipeline. But, really the hard work has just begun here, Jim. The social license, the getting the support, corralling support of the local communities, that's the big job over the next 2 years to get this thing built.
Now, with LNG, Aboriginal groups have said, we're fine with this, we've been on board, but the negotiations for that started 9 years ago, and they're saying you should have been talking to us 9 years ago about the Enbridge project as well, not starting now.
Well, I think that's true, and I think where the whole industry has got caught flat-footed is that, 9-10 years ago, resource development was done a different way. The opposition to these things have really galvanized. Now they know how to use the internet. Small voices know how to turn themselves into very big voices. And really public opinion has shifted. This used to be a very straightforward process of getting approvals and things done, but nowadays people really want more information from industry on what the spill potential is and what the safeguards are against spills and leaks and what the detection technology is for leaks. Like, they want to know all these things that before they never wanted to know. So that has really caught the industry by surprise. They've been slow to respond. They respond in very engineering type ways without really addressing, I think, the emotion behind people. They really have been very slow to adjust to the new reality.
Well, it doesn't help Enbridge that they've had a major spill in Kalamazoo that's still bubbling up oil all over the place, and they didn't know about it until locals were saying, what's this guck showing up in our river? Mm-hmm. I mean, when you have a record like that, it's hard to convince people that we have better technology now. It's
true. And I think that's just going to be part of the cost of doing business now, that they're going to have to amortize in. And, of course, you and I end up paying for that in higher energy prices. But I think people are okay with that, because the reality is that once human ingenuity starts focusing on that, they are going to find some relatively cost-effective solutions that can make that work. You just need to take a little bit of time and money to make that happen.
Doesn't help, too, that the latest study found we don't have the equipment to clean up a major spill if it happens in Vancouver, and especially if it happens up north where you don't have a big harbor infrastructure already in place.
Well, I don't think there's any such thing as an ability to clean up a major spill. There really isn't. So obviously prevention is the cure there. So, but I think even for minor and medium spills, the industry has to show that it has spent the money to have the response time be minimal and the effectiveness be maximal. So I just think industry's been very, very slow to talk about that and really address those concerns head on. They just keep coming back with, yeah, well, we create a lot of jobs. Yeah, well, we create a lot of jobs. And I'm just not convinced they're really tackling this the way they should be.
Right now, the way the legislation is worded, if there is a spill in Kitimat or in Vancouver, the province would be on the hook for the cleanup, and the province that sent the oil, Alberta, wouldn't have to pay a penny.
Well, as BC Premier Christy Clark has said, there has to be these 5 conditions, and one of them absolutely is BC's fair share. They rightly say, hey, Alberta gets all the rewards and we get all the risks. What's that about? So now she's got to figure out a way to negotiate that into her deal.
Of course, Alberta argues, well, we don't charge BC for the power lines that carries your hydroelectricity through our province. But no. I think we haven't heard of a big electrical spill lately, have we?
Good point, Jim. I just don't think that Premier Clark is really that interested in trying to eat any of Alberta's pie. It's just a question of kind of making her own pie and figuring out how to do that through either royalties or the LNG surtax charge she's talking about. So we'll see how it goes.
With LNG, will there be a market for it by the time that the plants are all up and running in Kitimat? Plus, I checked, there aren't enough ships right now in the world that can carry this product. They're building them like crazy, but will they have enough ships to carry it, and will there be a demand for it by the time it's completed?
You know, those are all $64,000 questions. I was taking the first one, will the demand be there? Right now, I'd say probably, just because gas has become the world's major source of supply, and both Asia and North America are moving towards using more and more gas. So, but having said that, Jim, it's interesting you bring that up, because right this week, LNG prices in Asia are at the lowest they've been really since the Fukushima disaster in March 2011, which just sent LNG prices on a huge tear, up to $18, $19, $20 per million cubic feet in Asia. Now it's down just under 12. So when the price is just under 12, the economics of LNG are still okay, but they're not great. So, but certainly, I think the other thing I would say is that most of the consortiums who are building LNG plants on the west coast of Canada, they just want the gas. The economics aren't that important to them. As long as they don't lose money, I think they just want the gas. They want that secure energy supply. They want a diversified energy supply. They're a little nervous getting all their gas from the Middle East and Qatar or from Russia, and they really want to have a secure, diversified supply of nat gas, and they're willing to pay for that in Canada.
Well, when it comes to securing supplies of gas, Ukraine's been cut off again by Russia. That happened a few years ago as well, except in the middle of winter, which was very pleasant for those folks. It seems that Putin's word isn't worth a penny.
Well, I don't know about that, because I see that it basically says if you don't pay, I'm going to turn off the gas, and he's done that. So I think he's been a man who's true to his word. But certainly the way that we do contracts and business in the West, it's a different game over here, isn't it?
A question I have, too, about gasoline prices in the Vancouver area, well over $1.50 a liter, and oil trading at about $104, $106 a barrel. Well, I remember a few years ago when it went up to almost $150 a barrel. Gasoline prices in Vancouver were around $1.50 a liter. Well, if they're already at $1.50 a liter at these prices, what would happen to the retail price of gasoline if the barrel price hits $1.50? Yeah,
you'd see some pretty severe demand destruction. That's for sure. In the U.S. they have a rule of thumb that after gas hits $4, you really start to see a significant decline in demand. We don't have any such metric here in Canada, though I'd like to think that maybe $1.50 would be it. At $1.50 a liter, do we see demand destruction? I don't know. Is it $1.60 that we start to see demand destruction? Tough call. But I think we are going to find that out this summer, Jim, because I think that gasoline prices are going higher.
Is there any danger that we could face oil and gas rationing in North America? Because we have promises from both President Obama and Prime Minister Harper to Ukraine and other countries in Europe. If Russia cuts off your oil and gas, we're ready to step in and help.
No, we're not going to see that. We're swimming in oil. Despite all that we hear about this, we're actually swimming in oil. So it's just really the tightness in the international market that's driving prices.
What about coal? Now, I know China still has coal-fired train engines, for example. Their pollution is so bad that their life expectancy has been reduced by 6 years. Are they going to go cleaner, or are they going to still use a lot of coal?
Well, I think that they'd like to see themselves get off coal as much as possible. I'm not a coal expert on either the politics or the commodity, but I would say that, most people in the West are certainly surprised to hear that coal still heats the world for 2/3 of the population. So that's a stunning number. And so really it's still very cheap. It still works. And you think of the infrastructure cost to transfer to gas or any other more environmentally friendly fuel, it's a lot. So I don't see coal going anywhere in the near term.
What about using natural gas to power our cars?
Well, again, you're talking about such a major infrastructure change. that would just cost a fortune. These CNG plants, gas stations are very, very expensive. That's why I think actually the electrical car really does make a lot more sense, simply because to set up a gas station for hydro, a hydro recharge station is about 2% of the cost of a natural gas station at the retail level. So it really, that makes it almost a no-brainer as to how we're going to move forward.
I was thinking, too, if natural gas became the popular way to power your car, well, why not just get a compressor and put natural gas in your car using the natural gas pipeline to your house?
Well, that does make sense, Jim, except for the fact that most people are pretty stupid. And the reality is that to ask the average homeowner or person to do that with something that's unregulated and has different machinery, I don't know how well that would go. Yeah. I think they'd probably still want to keep all that infrastructure fairly centrally and commercially located.
And how would
if you're the neighbor of a guy who is really not that mechanically adept and he causes an accident, that's a mighty big boom.
And as well, I'm sure the provincial and federal governments wouldn't be too happy about that, because then how do you collect all those road taxes?
Good point, Jim.
I mean, right now, if you did it, they don't have any way to tell, whether that natural gas has gone to heat your home and business or whether you've put it into your cars and trucks.
Mm-hmm. That's right.
But, the Beatles song, Tax Man, they'll find a way to tax you on it.
Oh, you bet they will. That's the one thing they're really good at.
What about alternate energy, solar, wind, tidal? Any possibility that's going to have a major impact or not?
Oh, Jim, I don't know. I don't follow any of those sectors. I can't spell solar.
Well, it starts with an S. So, I mean, when you're factoring in the oil and gas, any chance that there's going to be a diminishment in the demand for petroleum products?
Oh, you're already seeing that on a regular basis. The demand in the States is down year over year every year. Just by a little bit, but the trend is pretty clear. So, but the reality is that we're now exporting so much refined fuels overseas that's more than made up for that. That's why we're seeing higher gasoline prices, because the incredible amount of exports that we're sending out, because our oil, all through 2011, 2012, and a good chunk of 2013, was quite a bit cheaper, $10 to $20 a barrel cheaper for light oil here than anywhere else in the world. So our refined fuels, because we also have pretty low cost centers in the Gulf Coast, quite a bit cheaper fuel here than the rest of the world. So you're seeing now that gap kind of narrow a bit with the continued but slow recovery in the U.S. economy. But no, it's all about exports. That's why our gas prices are so high, because we export an incredible amount of refined fuels overseas now.
And I think one thing maybe that would hurt the Enbridge project getting public approval is that, well, gosh, if you're shipping all that oil from Alberta through BC, how come we don't see lower gasoline prices for it? I think you answered the question before, an incredible amount of exporting.
Yeah, there's no such thing as a local discount in the energy market, Jim. It's all a global market. It is, you could have a home right beside the biggest refinery in the world or the biggest oil deposit in the world, and it's not going to make a difference as to what your oil prices are.
Yes, I seem to recall up in Peace River, my dad telling me they had a shortage of diesel fuel, and I said, how's that possible? You're right in the middle of the oil and gas patch.
Yeah, but you're way better off being closer to a refinery than you are being at the upstream part.
Unless you're downwind from it.
That's right, Jim.
Although they've really cleaned up a lot. I remember the east side of Edmonton really used to stink, literally. And the refineries are still there, but they don't put out the big black plumes of smoke and smelly stuff they used to. So they've really helped clean up there, which is a good public relations and health thing.
Yep, that makes sense to me.
China has told them to put pollution control equipment finally on their cars. They're selling 50,000 cars a day there. What's that going to do for the demand for oil and gas?
My God, I had not heard that statistic. That's incredible. That has to keep you pretty bullish on oil, doesn't it?
Well, it sure does. And I've seen their new freeways are 10 lanes wide, but there's no real good off-ramps. So you get onto the freeway and you just sit there.
I've heard there's been 3-day traffic jams.
Yeah, and in Thailand, people are now living in their vehicles because they can't get anywhere in Bangkok. So when they say Vancouver's got the worst traffic congestion in North America, we don't
know anything about traffic congestion.
Yeah, at least it still moves and you get home eventually. Keith, thanks a lot for talking with us. Are there any particular websites people should go to find out more about what you do and what you think is going to happen?
Well, certainly my website, anybody can visit. We have 1 to 2 stories a week that go up there for free. You don't need a subscription to read them, all about educational aspects of the oil and gas industry. Mostly the upstream part, which is the part closer to the where the oil's in the ground, though we do write a little bit about the refinery sector. But it's oilandgas-investments.com. From there, they'll be able to learn a lot about, in very simple English, what's happening in the energy industry.
After the break, David Smith on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is David Smith, Senior Analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show.
It's good to be back, Jim.
Gold, gold, gold. Big and heavy and hard to hold. This has probably been its best week in the last 4 months.
Things have certainly turned around, not only for gold but silver as well. And I think it bodes well for the likelihood that the lows are in a pretty significant way, and that the next bull leg for the secular bull market is going to get underway, even if it takes a while to become really, really obvious.
David, you talked to us last week about what you thought was going to happen with gold and silver, and sure enough, we have audio proof that you were bang on with your prediction at TalkDigitalNetwork.com. David, maybe reflect a little bit more on what you said last week and how that's all playing out now.
Well, this is pretty fascinating, and I want to give credit at the outset where credit is due, because the day that we're speaking of was June 5th, which was a Thursday before last, and over the weekend I got a call from the executive producer at House Street, and he said, "Did you notice what the charts look like for gold, silver, and the U.S. dollar on Thursday?" And I said, well, I check intraday prices sometimes, but not that day because it was a quiet day. So I went back and looked, and darned if we didn't find out in our discussion that there had been a key reversal day on all three of those entities, gold, silver, and the U.S. dollar. And for those people who are not technically inclined, a key reversal day is when prices trade higher and lower than the previous day or week, and then they close higher or lower than that particular range. And so if we were looking for a bull move, we'd want to see the close being higher than the previous day after it had traded outside of that range, and the opposite for a bear move. And so in the case of the U.S. dollar, it closed down below on that key reversal day. It had a fairly big day, and gold and silver closed above that day, and it did so on very good volume. And I think the reason not only I, but probably a lot of other people may have missed it, is because it was trading within a fairly narrow range. Prices had been pretty quiet for quite a while, and so on the surface it wouldn't look like anything special, but when you looked at it and saw what happened, it was kind of like a little tea leaf that's giving you a clue about what might be taking place. And so you and I talked about it the week following, and it was posted, as you mentioned, where readers can go back and listen to that discussion. And we said, nothing is cast in stone, but what we do is we look for indicators like this, sometimes that many other market participants may miss, and then we find the more things that seem to support that, the more confident we are that perhaps our analysis is correct. And as I mentioned to you at the time when we were talking about this, I said, we want to see the next few days are going to be very important, because we don't want to see those prices exceeded in the opposite direction, because that would invalidate our analysis. We want to see it continue to move away in the direction of the key reversal. And so that's exactly what happened. In fact, it's happened in a pretty explosive way with gold and silver moving away from that reversal day, in other words, out of support and up into resistance. And as you mentioned, having a very powerful day yesterday, and then those today, which was up slightly, but it kept all of yesterday's gains, which were truly large, as you mentioned. And so that was exciting. That volume was very high yesterday and today. And, nothing's 100% in this world, but more and more we're getting evidence that the area of support that was established over a year ago in the metals is very likely to hold. And of course, the mining stocks themselves actually started moving up a few days before yesterday and continued to support that move. Now, in the case of the U.S. dollar, it has not fully carried out our premise yet. It has not been able to exceed the high of the reversal day, and that's encouraging, but it's still trading in the lower section of that intraday range, so we'll have to watch on that. But regardless of what happens with the U.S. dollar in that particular case, the fact that the metals made their turn on very large volume indicates to me, in my technical analysis work, that the bears are going to have their work cut out for them if they're going to try to chew down into all this new resistance to their move on the downside, which has been established just over the last few days.
When any kind of commodity moves in a large volume, I think that indicates there's high interest in it.
It does, and volume in the direction of a particular price move is very important. Again, nothing is 100%. Sometimes volume can give the wrong signal because, as you know, there's a lot of high-frequency trading that takes place in many of these markets. But the thing is, again, the more indicators that you have that support what you're looking at, the more likely that it's a valid move. And, next week will be very important to see how the market handles this new rise, whether it consolidates at this new higher level, which is a breakout level in gold and almost a breakout level above $21 in silver. And we want to see how that holds. And indeed, if we get a retracement back down into that support of the last 2 weeks, we want to see that it does so ideally on lighter volume than what happened before, and then see how that is dealt with. But I think it's going to be a fascinating week. And I'm pretty excited about this because, boy, I'll tell you, we've had a long 3-year slug in this cyclical bear market within the context of what I fully believe is a major, major bull market that has yet to fully express itself on the upside.
Earlier on the show, Ross Clark from CIBC Wood Gundy felt that perhaps gold might hit 1430 to 1470 this year.
That would be very impressive. And, there's a lot of resistance above here. So this doesn't mean clear sailing for the bulls, but what it does mean is that at the very least, we have more confirmation that the wide trading range is going to be supportive of not going down to new lows. Or if it does, it's more and more likely that if those lows are penetrated, they'll be on a spike basis where prices go down briefly and then turn around, because it uncovered so much buying here where we were, and it wasn't even at new lows. It was in the moderately low part of the position, that it really gives credence to the fact that anytime prices dip down into that area, there are buyers ready to scoop up the metal and also the mining shares.
I also think the surprise civil war in Iraq is a big factor for anyone trying to secure their money.
It really is a wild card because we just don't know how far things are going to fall apart there, because it's already influencing oil and causing the price to rise there. Inflationary expectations, I'm paying north of $4 a gallon for gas. And I think, I don't know if we're that way across the country yet, but I think we're getting there. I think I read something today that this will be the first time in 6 to 8 years when we've seen a $4 a gallon gas that is pretty much the norm across the country. So we're moving into fairly new territory that we haven't visited for some years in the case of the price of gasoline.
Wow, you're getting a break on the price of gas. Try Vancouver, where it's $1.55 a liter if you're lucky, and that would translate easily into $7 a gallon.
Well, it looks like we're going to see at least high, if not higher, oil prices for some time to come. And this is really kind of amazing in spite of all the drilling that's gone on in the States in terms of fracking for natural gas and also the shale deposits for oil. So it just seems like no matter how much they drill out of the ground, the demand just keeps going up.
And for more information, check out the Morgan Report at silver-investor.com. Thanks to our guests, Ross Clark, Keith Schaefer, David Smith, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.